Okay, everybody, we're gonna do a quick A plus setup of the week for you guys. And yeah, but before we hop into that, we wanna go into just some overview of the global macroeconomic outlook. Some things I want everybody to understand, keywords, tricky phrases. I'll be saying risk on, risk off sentiment a lot. And what is that, right? So when we talk risk on, risk off, we're talking about the ways that individuals, countries, and corporations finance things, right? In general, right? So there's debt finance and there's equity finance. So if you need money for your business, you'll create what's called a corporate bond system, or a junk bond is what they're called. Um, but a corporate bond has a higher interest rate. You put your money into that at maturation, you get a return based on how well that corporation has done in that period of time. If they're making money, you get paid. If not, then the interest is equivalent to that amount of gain, right? But then you have government bonds, like we're looking at this S&P in relation to the 10-year government bonds, right? And government bonds have a little bit more backing. They go to build roads, uh, more for private sector work, right? Government. And in times of war, you'll probably see those values going up. And in those times, right, when the Federal Open Market Committee, and not just the FOMC, but mainly the New York Fed, when they're doing open market operations, meaning when they're buying and selling bonds, in this case, they're buying bonds. What that does is it increases the money supply. We can go into more excruciating detail as why that happens, but you can take a economics class and get that done. Essentially, what happens is the money supply increases because they're exchanging bonds for US dollars. So they're buying the bonds back from the public in exchange for US dollars, thus injecting money into the market. All right. So when we talk about risk on, risk off behavior, risk on behavior is whenever people are feeling risky and they want to put their money into equity finance and the stocks. So whenever we're risk off, that's the exact opposite of that. And that's what we're seeing right now. Looking at this chart, it's the S&P on the dominant side, the 10-year bond on the recessive side of this teeter-totter. And as you can see, the S&P is selling for bonds. So if you're wondering where the money is going from the S&P, there's a clear cut picture of them changing their bias from long to short in that regard, because we've streaked across this entire triangular formation. So I just want you guys to understand that. And then also looking for these A plus setups. I'll be looking at some currencies. I'll be looking at some other things for you guys. But when we talk risk on, risk off, we're talking in relation to the S&P 500. That's 500 of probably 504 of the top grossing US stocks on the stock market, and they're put in a basket called an index, and then that whole index is traded. So if all of the majors are doing well, if all of the top performers are doing well, then so will the S&P. But as those top performers start to degrade in their gains, that's you'll start to see that come out into the charts in the form of bearish sentiment. Okay, so when we're talking about currencies, risk on, risk off, currency pairs, the risk off pairs tend to be the US dollar, the Swiss franc, and the Japanese yen. Now, don't hold these as rigid standard rules, right? So the market can do whatever the market wants to do. And certain times, these currencies can act however they want. It just depends on where the money is flowing. But the rule of thumb is the Japanese yen, Swiss franc, and dollar are the risk off pairs. The riskier pairs are the Australian dollar, the Kiwi, and the Canadian dollar, and then the neutral pairs are the euro and the pound. So you'll see that in times like this, because of the geopolitical situation with the US, Israel, Iran, and the other powers that be, there's currently a stranglehold on the oil flow out of the Strait of Hormuz. So the oil markets have been the key market of focus. So you guys will see the S&P is losing interest. The gold market is even losing some interest. You'll see in a little bit that supply is starting to come into that market. The gold markets, however, are bullish. The VIX, the fear index, which opposes and counter correlates with the S&P 500, is a direct correlation with oil, crude oil. And since crude oil is the main point of focus, that leads us into our currency of interest, which is the Canadian dollar, which has increased their supply of crude oil. 90% to 70 to 90% of the oil that's produced in Canada does come to the US, but they do distribute oil globally as well, right? So 'cause that's just how economics works, right? Trade is usually good for everybody. And yeah, so let's go take a look. Let's go look to find our best setups. Where's the money going? Because right now we can see the money is flowing out of the S&P 500 and into bonds. So does that mean go buy bonds? Yeah, if you want a 4% uh increase, right? If you want to kind of nail in 4.1% or 4.2% interest over the next 30 years. If that's what you want, go for it. But I think we can find a little bit more in a shorter time if we continue to do what we're doing right now. So we're looking at US 30, the Dow Jones Industrial in relation to gold. As you can see, it is also below the 50 MA, which is that red dotted line. Um, so that shows again risk off sentiment and equity finance in relation to commodities. Last time was equity finance in relation to debt finance. Debt finance was winning. And right now, although equity finance is losing to gold, gold is also rebounding, as you can see, in relation to crypto. So this is another thing that's a little peculiar. Crypto's still below the 50 EMA. We can see the base here that broke. We have another low base that potentially could break after we make contact with the supply back up here at the 14 level, right? This remember this is just it's really just a comparison, a correlation, right? We've been in this downward sloping trend channel and this downward sloping speed line for a while. And we're basing here, but this base does show some support. We can tell that bullish sentiment did come in. Supply has diminished slightly. The candles got a lot smaller. They're more constricted, and we're finding this stall in price, right? This consolidation. Could this be bullish? Not quite sure yet. It is a good sign that prices have slowed down because Bitcoin is now almost even with gold as far as because gold is losing some of its gains. Bitcoin has lost a lot of its gains. There's room to shift the power structure. Now, Bitcoin being used at times of war, I'm not sure if we've seen that in the past, but this may be, a decentralized way for countries to make payments to each other without being noticed. That could be a thing. So I don't know. However, the banks want to use this or whatever information is there. It's here for us to acknowledge. So that's why I'm coming here and looking at it. Bitcoin has consolidated, it's stalled out in relation to its descent against commodities like gold. So here we've got the S&P 500. If you were in my subscriber group, I talked about what I was looking for. We talked about where the supply had introduced itself, the areas where we were going to look for bullish sentiment, we do expect prices to come back down to that lower level, about that 65, 50 level, and then we'll see what happens there. We may get some intercession from the powers that be, right? The war could spark government uh, spending, of course, but then those governments utilize corporations within that S&P 500 for warfighting capabilities and other things. So that could increase production and create jobs and do some things to stimulate the economy, which could show up on the S&P 500 as growth. That's, you know, not something that I can definitely say is the highest probability of happening. But right now, what I can tell you is supply is introducing itself into this market, and we do expect prices to continue to go down as long as we have more fear in the market than we do risk. That's what's likely to occur. And you'll see that this looks the exact opposite of the volatility index, the VIX. And speaking of, we're right here back into the fear index, the volatility index. This is the S&P volatility. So as long as this is going up, fear is rising. If fear is going up, then that means we're more in a risk off territory. And I've got a number of alerts in areas um, associated with some of the most risk that has come up. We've got COVID level risk back here in the 2020 range. We've got some of the other notable risky times in the market, flash crash last year, where that happened, and we could see as we get higher in the in risk, we should look for bottoms in the risk on pairs. We should look for those bottoming actions to occur. There'll be V bottoms, so they'll be very hard to get into, but we will be alerted when we get up there. So we'll have a little bit more time than the average bear. So stick around and maybe we'll catch those highs together. I'll definitely be here for it. So right now, the VIX is at 27, 28, which is still pretty high. 29 is where my alert came in to let me know. And sure enough, here we are, right before monetary policy statements and everything else coming into next week. So there's a lot of volatility coming in, which is why I'm doing this now. So we got gold to the dollar. We can see that there's plenty of supply that introduced itself, pushed prices down. We expected prices to at least take a break and move in this horizontal range here that they had created, but it ended up making this upward trend channel. But even this upward trend channel is starting to push itself out of that channel. So we do expect and note that supply has introduced itself, much more supply volume here, right? On this bar, analogous to these bars. This bar here, which was an up bar, it's the same amount of effort, but with the volume showing that, hey, we can't really close above this closing price. So the supply here that was introduced is still present, not as much as it was before, but the supply is still definitely present. The demand is starting to dry up, but there is both supply and demand left in this gold market. Here shows a bar that has less volume. So the effort to go higher was thwarted easily by the effort to push prices down. The next bar put closed below the previous closes, but it hasn't closed below the previous lows. So that's not my signal to say, hey, gold is bearish. It's taking a break, which is giving other things to kind of ramp up their intensity and ramp up their bullish sentiment. So if the money's not in gold right now, if the money's just holding stagnant like we saw, where is it going? Because we know equity finance is not where it's going. If it's sitting here still in gold in a stalemate, then this isn't where we want to put our money either at the moment. We got the Vanguard Total World Stock Index, and looking at the global equity markets, the Nikkei 225 fell from 16% to 10% to 6% year to date. That was our biggest gain on the year. That was my dark horse for the equity markets, the K225. Also, we see a lot of the other equity markets. The Euro Dow is only up probably about 0.95% for the year. The FTSE is only up probably about 3% for the year. FTSE 100 only up 3%. The CAD's up probably about 3%. The dollar's down 4%. And we can see that in the S&P's numbers and where things are. But remember, the S&P was lingering in the middle nearly. Here, the total world stock index has already made its way all the way back to that support. So this would be precursory if the total world stock index falls and continues this bearish outlook. Um, as we've changed character, as we came into this, there was a lot more bullish sentiment, and it took a lot more time to get across the range. It seems like there's a quicker move to the downside, and we're starting to fill into this bullish candle here. But yeah, it still looks pretty bearish to me. We're below the 50%, the 50 EMA. And yeah, I think, like I said before, risk off sentiment is not just in America, it's a global thing. So it's a macroeconomic outlook. Here, we got Nas. Nas has already made its attempt, checked the lows, made its way back up to around the 61 to 50% of that retracement, and has started to make its way further down while holding this supply below the 50 EMA on this one. So this is a sign as we came in bullish here, and we had bullish after this sign of weakness here, another sign of weakness, and then a diminish demand at this point. Demand is diminishing because we can't make a rally higher to these highs. So we've got the up thrust action here, which a huge no supply bar here on the daily. I mean, no demand bar here on the daily, no demand, up bar on low volume that basically creates an up thrust and with can't be sustained, right? And here we just can't. This looks like an extremely bullish bar, and we're already back to halfway through that bullishness. So again, equities not where the money is. Here, crude oil futures. Want you guys to take a look at this crude oil future chart and tell me if it looks like any other type of chart that we're going to look at soon. So here's crude oil, got the accumulation, last points of support, the breakout where phase E trend out of range looks bullish. The next level of resistance is all the way up here at $136. There was a previous high of 119 per barrel. But remember, oil is priced in dollars. So right now we're looking at $99.85 per barrel of oil. So again, US government bonds, what does that look like? All right, looks like oil and the rest of them, right? We had our accumulation, checks to the downside, last point of support, the breakout above, nice flagpole style breakout. I would like to see this go up a little bit higher. This is the 2-year bond has gone up to 3.732%. Remember, the US interest rates are at 3.5 to 3.75%. That's what the banks will give you for keeping your money in a savings account, right? Give you 3.5 to 3.75% APY, right? Here we got 4.257 on the 10-year bond and 4.8% on the 30-year bond. You see the 30-year bond came out of its upward trend channel and really just made its way more sideways at that 50 level. Couple signs of weakness. As long as these overbought boundaries match our stochastic down there on the bottom, it's oversold where it's oversold, it's overbought where it's overbought. And we've made an oversold. You can see this here. There's a bullish divergence on the stochastic. We wait for a pullback on bonds to see where the failure swing is. If we can check that, then we can find another entry on bonds. Not to say that you could trade the futures markets to kind of trade those probabilities, right? But speculatively. But all in all, the bond market does have signs of bullishness, and of course, risk off sentiment. So that's the main thing. Dollar index still sideways. Nothing really major there. We'll come look at crypto really fast. I'm not interested in crypto until we get up above some of these other levels. But remember Bitcoin and the rest of them, remember how it looked against gold. We had the base above, the base below. They're still doing the same thing until we can start breaking out above. I'm not really a proponent for crypto at the moment. I'm not for that. But the A plus setups of the week are coming here from the Canadian dollar side. We do expect the US to be buying oil from Canada. So we do expect that the dollar would continue to play short against the CAD as the CAD continues to rally higher. Here, Euro CAD looks great, pretty clear and obvious that they've been shorting that. So what we would look for is the opportunity, probably closer to um, here on the way up because we got the clear cut impulse to the downside. We want to look for somewhere around the 50, the 61, and the 76.4% for those as a continuation into this bear move. Kiwi yen, right, that we talked about. We were already short on this, but and trying to catch more into these shorts. Oh, we got stopped out right there. But here it's starting to clear up a little bit more. Like we said, we got the pullback, right? You could call this from there to there. We got the pullback and the extension down. We didn't quite break the rest of those lows, but that's something that we can look into a little bit more. Like we said, as crude oil prices increase, the the, the CAD is starting to increase their supply of oil to meet the demand. So we can expect countries to be exchanging their currencies for Canadian dollars. So Aussie CAD, I think this one has a little bit, there's a lot of strength in this move. We got the 50 EMA retest. We got the movement to the upside, but they did not break those highs, even with a nice, healthy test of the 50 EMA here on the daily. So it does show that supply has introduced itself in the market. The Australian dollar is one of the stronger pairs. The Australian dollars has been coinciding very well um, with the gold market. So what happens with the gold market, I correlate here with the Australian dollar. What's happening with the oil market, I'm correlating that with the Canadian dollar, gold and black gold, Aussie and CAD. So as gold proceeds to kind of taper off the same way that the Australian dollar is, I'll be looking out for this one. This is not one of my A plus setups, however, because there's so much strength in the Aussie and there's so much strength in the CAD. I wouldn't want to put two strong pairs together. Let's find something a little bit weaker. And as we get to this point, we have pound CAD, which looks like it's in the later stages of a distribution. So consider this a distribution area, automatic reaction point, check into those, right? And matter of fact, not everything is a straight line. I want people to understand that. Not everything happens here in a straight line. So as we look like this, we can see a slightly different picture. But this picture here shows us that we've already broken out of this upward trend channel and potentially could push back up into this area, the 50% of this move, and continue to break down. That's something that I'm looking at here. But the pairs that I think will do the best are the Canadian dollar dominant moves. So in this small area here, which I have highlighted, we can see a slight stopping action, and a quick accumulation area there that is would be phase E of that minor accumulation range there. But essentially, this is our area of interest where we've come out of the tops, tested the maximums and the minimums, and we're starting to make our way up more out of this overbought area. So until we can get really much further above here, CAD Swiss, I'm not saying that the CAD is performing as a better safe haven, because as you guys can see, the CAD has been selling for Swiss franc for quite a while now. So the sentiment hasn't changed until we break above this 58 cent level, but we're right now at 57 cents, 631. So that's that's something that I'm looking at. I want to see if there can be more bullish sentiment found here. But the main pair that I'm looking at is this baby right here. This is our A plus setup. This is CAD yen. The yen has been extremely bearish. Um, the Canadian dollar, like we said, oil is pretty much tied to the CAD right now. We've got a very nice move to the upside. It's been really beautiful right here. Nice clean projection to the upside. We made our way out of this upward trend channel. We made it out of this sideways range. We made it out of this reaccumulation base, and we're starting to push even further up. We may not even make any more moves backwards, but we can pull a nice fib from the lows to the highs here and map this out even. Do I think they'll come back down to $1.13? Do I think they'll come back down to $1.15, especially with now that we're here at $1.16? I'm not sure. I don't think so. But for target purposes, you've got $1.20 target, we got $1.25 target. So whatever happens from here, whether it's a 38% pullback or whatever, I think the best way to handle this is to take the long position, probably about 3 to 1, set this below the last point of support. Probably use that 50 EMA as well, 50 EMA last point of support, and just run that and see what we can do there. Now, note this is on the daily time frame, so when we get closer to the yen monetary policy statement, the CAD monetary policy statement on to Wednesday next week. That will be when we'll dial in and we'll come down here to the 1 hour. We'll come down here to the 5 minute, and we'll really be able to see what's going on, and we'll be able to change where we really want this stop loss to be positioned. So that's just something I want you guys to be aware of. But right now, those are the areas where I would consider placing the stops the most, the last points of support, and we'll see. But right now, A plus setup, CAD yen. I think you guys should take a look at this. I think we'll look back probably in June and see that this worked out similarly, especially with the geopolitical situation that we're in right now. I don't see the macro matches, the technicals match, the relative strength matches. Um, I gotta check. I gotta check COT. COT probably matches as well. As far as COT from COT doesn't match from last month. The yen is a little bit more neutral than the Canadian dollar, but we talked about the positioning of longs and shorts there and why they would be positioned more short. So they're selling more of their currency to other places, right? So that's that's what I have for you guys right now. Looking at CAD yen to go long, and yep, that's all I got. I don't want to take up too much time. Y'all enjoy that. I'm out. Peace.